Hey everybody, this is Bill Black with Northwest Funding Group. It's Wednesday, May 10th, and the CPI numbers came in and kind of want to go over some information around that. So, good news, we've up 34 basis points. We're expecting the inflation to make a pretty big improvement, but there was a couple little glitches that we'll go over and talk about why. But things are going to look good as we continue to go into the summer for improved rates. So let's go ahead and get started on this presentation here that I put together real quick. So basically, the best news of the day is FHA dropped those just ridiculous debt to income based pricing adjustments. So the DTI that was set at 40% or above had a hit. They pushed that out, and they also just announced that they are no longer going to be doing the credit score hits with that. So that's a great thing. So talking about the CPI, let's go take a look at the headline was 0.37%, and that means a drop of inflation from 5% down to 4.9% year over year. The core is 4.41, a drop of 0.1% there. And then the shelter, which has been just kind of a spur in our back for a long time, at 43% of the core is where shelter is. That means so the CPI is basically a basket of goods that we need on a daily basis. So that would be our shelter, our fuel, our cost of a car, all of those items that we are needing on a monthly basis. Prices go up, inflation costs go up, and then they're averaged over a 12-month period. So the May 10th comes out, then we replace the April 2022 with April of 2023 numbers. So what we're going to be talking about today is everything that came from April's information, and then June 10th will be May's, and we'll kind of go on and on. Okay. So the shelter is a big one, and it's a lagging number. Rent is up month over month by 0.6. Again, this is a very lagging number on the rents and the lodging side of things. The owner equivalent rent is 0.5%, so that actually increased a little bit, but all of this stuff is going to be correcting, and I'll go over that here in the next couple slides. Lodging away from home, this is the Airbnb costs and the hotel costs and that kind of stuff. We kind of feel like it peaked after COVID. A lot of people pent up demand, a lot of money rolling. People skipped a year or two of vacation, so they're splurging a little bit more, paying a little bit more, and at the same time, more people saw the opportunity and went online with Airbnbs, and there's Airbnbs all over the place now. So supply is lowering price, and you'll see those continually drop as more people realize that they're not going to get what they got last summer. Used cars was a fluke, 4.4% increase in month over month. We feel like that might be somewhat related to foreclosures were able to get started in January of cars. A lot of cars were basically like no payments for a year or two during COVID, and they started taking those back and putting them back on the market for used car sales that they've always did. And so that kind of increased the inventory. At the same time, tax returns came back. So we think that there was some funds available in tax returns that was allowing people to buy new cars, and affordability was a little bit better. So the demand was 4.4% on what was available out there. So the next slide here, we're going to talk a little bit about that shelter in place. So you see shelter crested. So you remember, we take the last 12 months and add all of those up, and that's what we come up with for a number today. So in March of 2022, then we were at 0.50. So we removed 0.50 as these lagging numbers kept showing. Rents were going up every month. They peaked in December, 0.79, 0.74, 0.76. This was the number reported. The actual number was more like the summer before, 6 months about before they actually got this number. So it's about a 6-month lag. And here we come, December. This is where prices were starting to already drop. And then 1, 2, 3, 4, and then 5, 6, we're going to be down here. So March 2022, gone, and replaced by March 0.56. So in April 10th, we replaced this 0.50 with 0.56. That increased a little bit on that inflation number. So come next month, we're now down to 0.42. We were at 0.50. So we're starting to show improved numbers as we go on in the shelter side of things, which is really solid. So talking about that a little bit, reiterating the used cars, 4.4%. If that was 12 months in a row of that, we'd have over a 50% annual increase in used car sales. That's just not going to happen. So we kind of feel like that was kind of a one-off. That used cars alone is 3.25% of that basket of core goods. And so that pushed that core reading up 0.14% from that 4.4%. And without that, the core CPI would have been 0.27 month over month and 5.4 versus 5.5 year over year. So that little fluke, once that corrects itself, we should see another correction next month and the next month once used car sales kind of subside after the big splurge came out on availability and the demand when income taxes came out for people, payroll taxes. So let's go ahead and say, what does this all mean? So basically, as the data continues to show slower economy, the whole goal is to slow down inflation. Feds increase rates slows down spending, and prices will drop and more. And at this point, August of 2022 was the greatest amount of savings in history. That's all gone now, and now there's the greatest amount of debt. So the spending habits, when people are getting unemployment and all of this free money out there, and and pay increases, and they spend, and now it's like, okay, I'm running out of money. I might not splurge as much, so I'm going to stop spending, and they have to drop prices, and the demand lowers, so more supply comes up, inflation drops, the Feds get to lower their rates. So they increase rates 10 times in a row. Every time they met every few months, they've increased the rates 10 times in a row. So they're now all the way up to 5-6%, and so they used to be down to zero. So they have the ability now to lower those numbers drastically if they need to. So how I kind of explain it is we are going into a recession. Things have to slow down. It just can't keep spend, create money. Inflation is going out of control. So how I say it is, when they were giving trillions of dollars out, that's a big party. Everybody has money. Everybody's blowing it. Uber Eats. Let's go out to dinner. I got money. I got money. I got money. Now that gets depleted. No more free money. It's drying up a little bit. The hangover has to stop, where people stop ordering their Uber Eats, and they stop, getting all of this expenses that they might not, 150 bucks a month at Starbucks. They're starting to look at things like, okay, I maxed out $3,000 credit card at 27%. I got to slow down. I'm going to start making coffee at home. I'm going to stop spending some of my money, and we're going to see a slowdown there is kind of the thing. So a little bit of a hangover has to occur. Not a bad thing. A recession has never really showed how it affects housing. We actually think it's going to improve the housing market as the rates drop. So kind of talking about that a little bit. There's a huge pent up demand right now. There's a supply. There's just nobody moving out of their houses when they have a low interest rate. When they did get down to 5.99%, 5.875 for a few days here a few months ago, the demand just went skyrocketed. People got off their hands. They said, I'm going to sell my house. I can go buy now. And it doesn't make as much, when rates were 7.25%, nobody is going to move to go pay to get out of their 3%, go to 7.25%. So I did a little scenario down here of what that looks like. So this says Mr. Jones' home is valued at $400,000 today. Let's say he paid, I don't know, he owes $250,000 on it because he's been paying it down. But maybe he paid $300,000 for it 2 or 3 years ago. So he has $150,000 of equity, but he only owes $250,000. And when he refinanced this maybe 2 years ago, he got a 3% rate. So his payment was based off that $300,000 balance that when you refinance. And so his payment was $1,264.81 at a $300,000. So $300,000, 3% here on the left-hand side. $1,264.81 is his payment. Add another $500 for taxes and insurance. So a person owning a $400,000 home today, payment about $1,600, $1,700, $1,800, about $300, $400, $500 less than rent. He's sitting pretty. He's like, okay, I can't go rent. It's $2,200. So what do I do? Well, he's waiting for rates to drop in order to make a move on this, because he does want to move into something a little bit bigger. So if he did this today, the payment was based on, okay, so if he did this today and sold, and he, paid off his 5-6% real estate fee, his 1.78 excise tax, maybe even kept a little bit in savings, let's say that he wants to put out of his proceeds, he wants to put $120,000 down on a $520,000 home. So he's not going too extravagant, 400,000 up to 520,000, maybe another bedroom, bathroom, maybe a little bit bigger lot, maybe a little nicer area. So not going too crazy, but upgrading to $120,000. Now his rate's 6.5%. So by saying I'm going to go from a $400,000 home to a $520,000 home, I'm going to put $120,000 of my equity from my other home down. So now I have a $400,000 loan. So I'm just increasing my loan amount from 300 to 400,000, which typically, it's a little bit of a move, but not like this. What we're looking at is right now what it would cost him to increase to do this move and put the equity into the home of his new home. It's going to be 25, 28, 27. We're doubling his payment, and we're not doubling the value of his home. We're just increasing his house by about $120,000 is all we're adding to that. So you can see here, that should be 120,000. They're not 150. So you can see there, just by increasing from a $400,000 home to a $520,000 home, he is actually increasing the loan amount by 100 grand. And like I said, he's paying $1,263 more. That right there is exactly why people are waiting for rates to drop. So as they drop, as this 6.5 gets down closer to 5.5, this gap in payment decreases, and he's more apt to make that move. So, what are we doing today? We're kind of waiting, the market, but we're getting creative. We're doing some stuff like a 2-1 buy down. You can see in this case right here, I did a $500,000 purchase with a $350,000 loan amount. Their payment was $2212 without taxes and insurance. Did a 1.0 buy down, cost about 3 grand, save them 220. This is to do 2 years in a row of 1.0 buy down, but this is 2-1 buy down. I'm saving them $438 a month, cost them $79.65. Now remember, this $79.65 goes into an escrow account so they can get refunded back if we refinance, if rates get down below the 4.5%. So this kind of is a pretty popular thing right now, kind of really making a lot of sense. So hopefully that all makes sense to you. My name is Bill Black. I'm with Northwest Funding Group. And if you have any questions around the market, buying, selling, investing in property, reach out, give me a call. Thank you, and have a great day.